Welcome to the Deep Dive, your essential shortcut for getting up to speed on the latest earnings calls.
That's right.
Today, we're jumping into Griffon Corporation's Q3 2025 results. Our goal here is to break down those numbers, figure out what management is thinking, and, explore what it all really means for you.
Yeah, and Griffon's quarter was, it was a really mixed picture. You had a clear strength in one part of the business, but some pretty serious headwinds in another.
And the market definitely noticed.
Oh, yeah. The reaction was immediate and quite telling, really highlighting what investors are keyed in on right now.
Okay, let's get straight to those headline numbers then for Q3 2025. Okay. So Griffon reported a GAAP EPS loss of negative $2.65.
Whoa.
Yeah. Now, that number probably jumps right out at you. Sounds pretty stark.
For sure. Yeah.
But look, it's really important to unpack that. That GAAP figure includes a very large one-time accounting hit we'll get into.
Right, the non-cash stuff.
Exactly. If you strip that out and look at the sort of day-to-day operational performance, the adjusted non-GAAP EPS actually came in at $1.50.
Which was right in line with what analysts were expecting. So no surprise on that adjusted number.
Right. So that adjusted figure gives you a much clearer view of the core earnings power, without that noise.
Definitely. But while the adjusted earnings were okay, the revenue side of things was a miss.
Yeah, tell us about that.
Total revenue was $613.6 million. That fell short of expectations by about 5.6%, and it was down 5% compared to last year.
Okay, so revenue down year over year and a miss versus expectations.
Exactly. But here's where it gets a bit paradoxical. Adjusted EBITDA, so earnings before interest, taxes, depreciation, and amortization, that actually increased 7% year over year.
Increased, despite lower revenue.
Yep, reached $134.7 million. So you immediately see this divergence, right? Top line weak, but the underlying profitability X items actually looked better.
Okay, so that definitely warrants digging deeper. This difference between revenue and EBITDA, plus that big GAAP loss, it hints at some complexity.
Absolutely. You can't just look at one number here.
So the headlines tell part of the story, but like you said, it's mixed. Yeah. The real action seems to be happening within Griffon's different business segments.
That's exactly it. The whole story really boils down to the performance of two main segments, home and building products, or HBP,
right,
and consumer and professional products, CPC. They almost acted like two totally separate companies this quarter.
Okay, let's break that down. Which one was the star?
Oh, HBP, no question. The home and building products segment was really the standout performer here.
How good are we talking?
Revenue climbed a solid 2% year over year to $400.2 million. But more impressively, its adjusted EBITDA jumped a full 9% to $128.8 million.
Wow. Okay, so margins must have been strong there.
Very strong. Management pointed to, favorable pricing, a better product mix, selling more profitable stuff, and lower material costs. That all helped push margins up.
And what did that translate to overall?
For the first 9 months of their fiscal year, HBP margins were running around 31.4%. Super impressive. They actually exceeded their own expectations.
So they're raising guidance for that segment.
They did. They raised the full year margin guidance for HBP to above 31%. They're clearly feeling confident about that part of the business.
And it sounds like it's more than just general housing trends, right?
Yeah, I think so. They're really focused on the repair and remodel side, which benefits from, the aging housing stock in the U.S. It's less tied to the ups and downs of new construction, makes them a bit more resilient, perhaps.
Okay, so HBP is the bright spot. Strong performance, raised guidance, but that implies the other segment. CPP must be where the problems lie.
Bingo. That's the crucial counterpoint. The consumer and professional products segment, CPP, faced some really significant challenges. This is where that revenue miss primarily came from.
How bad was it?
Revenue there declined a sharp 16% year over year, dropped to $213.4 million. And the actual volume of products sold was down even more, about 19%.
Ouch. What did management blame that on?
Two main things. Just generally weak consumer demand, people cutting back, and then increased tariffs disrupting customer ordering patterns.
Tariffs again.
Yeah, especially impacting their Hunter fan business, which is a big part of CPP.
And does this tie into that big GAAP loss we mentioned at the start?
Directly. This leads us straight to that substantial Hunter fan impairment charge.
Okay, break that down for us. What exactly is an impairment charge?
Right. So Griffon recorded a $217.2 million after-tax impairment charge. It relates to something called goodwill and intangible assets tied to the Hunter fan acquisition.
Goodwill. That's like the premium paid over the physical assets, right? Brand value, reputation.
Exactly. It represents the expected future earnings power of that brand. When things change, like weaker demand or tariff headwinds, and that expected future value goes down, accounting rules say you have to write down or impair that goodwill value on your books.
So it's a non-cash charge. Doesn't mean cash just walked out the door.
Correct. It's a non-cash accounting adjustment. It hit the GAAP earnings hard. That's why you see that negative $2.65 EPS. But management was really careful to describe it as optical than operational. Meaning it reflects the current tough market conditions for Hunter fans specifically, but not necessarily a sudden collapse in the whole company's underlying cash flow or day-to-day business operations. Okay. Still, it's a big flag about the challenges in that segment.
No kidding. A $217 million flag. So, okay, CPP is clearly struggling. Revenue down, tariffs biting, big impairment charge. What's management doing about it? Are they just, hoping things get better?
No, they definitely highlighted some actions they've taken. Despite that big revenue drop in CTP, they actually managed to improve the segment's EBIT margin, that's earnings before interest and taxes, by 2.7 percentage points year over year for the first 9 months.
Wait, improve margins even with revenue falling 16%? How?
Primarily through shifting towards what they call an asset-light business model and better global sourcing.
Asset-light, meaning less owning factories, more outsourcing.
Essentially, yes. Moving away from owning all the manufacturing assets, using more global partners, it reduces their fixed costs, makes them more flexible, which is key when demand is volatile like this.
Makes sense.
They specifically credited their Ames U.S. team for driving this, making the supply chain more flexible and cutting operating costs. Management seems pretty committed to this strategy. They said, quote, "All of the actions are behind us, and they have optionality on where we're going to be sourcing from."
So the restructuring work is done, they think.
That seems to be the message. Their long-term goal for CPP margins is still 15%, which is pretty ambitious given where they are now.
Yeah, 15% seems a long way off from here.
They acknowledge that hitting that target really depends on consumer demand bouncing back in a significant way.
Right. Flexibility is great, but you still need people to buy the stuff.
So given HBP's strength and CPP struggles, how does this all shake out in their forecast for the full year?
Well, the updated outlook reflects that split personality. They did revise their full-year revenue expectations downward.
Okay, by how much? They knocked about $100 million off the top line, now expecting around $2.5 billion, down from $2.6 billion previously.
And that cut is all due to CPP, presumably.
Directly attributed to that ongoing consumer weakness and the tariff impacts hitting CPP. No surprise there.
But what about profitability? Did they cut the EBITDA guidance too?
Here's the interesting part. No. Despite cutting the revenue forecast, they reaffirmed their segment-adjusted EBITDA guidance range of $575 million to $600 million.
Wow. So they expect to make up for $100 million less in sales purely through better margins and cost control.
That's the signal they're sending. Strong confidence in those margin levers. Obviously, HBP's outperformance helps a lot there. They did trim the expected CTP margin slightly for the year, down to around 8%, because lower revenue makes it harder to absorb overhead costs.
Okay, so higher HBP margins are offsetting slightly lower CPP margins and lower overall revenue to keep the EBITDA target intact.
Precisely. They also slightly lowered their guidance for interest expense and capital expenditures for the year, which helps the bottom line too.
It does show some operational confidence holding that EBITDA line, but you have to wonder if that's achievable if consumer demand gets even worse.
That's the risk, definitely. It relies on things not deteriorating further and CPP and HBP staying strong.
Amidst all this, how are they managing their cash? What's the capital allocation strategy look like? Buybacks? Debt?
Yeah, they were pretty clear on that. Their focus is on long-term shareholder value, using what they highlighted as strong free cash flow generation.
Less strong.
They generated $261 million in free cash flow just in the first 9 months of the fiscal year. Pretty robust.
Okay, what are they doing with it? 3
main things. Investing back into the businesses, opportunistically buying back their own stock, and paying down debt.
Any specifics on the buybacks?
Yep. They repurchased $40.3 million worth of stock just in Q3. And if you look back since April 2023, they've bought back a total of $538 million.
That's a lot.
It is. They've reduced their outstanding shares by over 18% in that time. Plus, they declared their regular quarterly dividend, the 56th consecutive one.
Okay, so returning cash to shareholders is clearly a priority. What about debt?
They're chipping away at that, too. Reduced net debt by $76 million so far this fiscal year. Their key leverage ratio, net debt to EBITDA, is down to a pretty healthy 2.5 times.
And they expect to keep generating cash.
They project over $1 billion in free cash flow over this year and the next 2 fiscal years. They explicitly said they view their stock as a compelling value right now.
Okay, so strong cash flow, significant buybacks, steady dividends, and debt reduction. That's the positive financial picture counterbalancing the segment performance issues.
Exactly. It paints a picture of operational strength despite the CPP headwinds.
So let's zoom out a bit. What does this Griffon story tell us about the wider market, and what should you as an investor take away from all these moving parts?
Well, that HBP versus CPP split really mirrors some broader macro trends we're seeing.
How so?
HBP, the strong one, is riding the wave of high remodeling spending. It's over $510 billion a year now, apparently. Driven by, like we said, older houses needing upgrades, plus the fact that the U.S. hasn't built enough houses for years.
The people are fixing up what they have.
Right. Creates this sort of steady, almost secular demand for repair and remodel products like garage doors. Less cyclical than new home building. Griffon's HBP segment seems well positioned there.
Okay, that makes sense for HBP's strength. And conversely, CPP is caught in the tougher consumer environment.
Precisely. It's facing that weaker consumer spending, especially on discretionary items, plus those specific tariff disruptions hitting Hunter Fan. There's just a lot of uncertainty there.
Did management give any more color on the retail side?
They mentioned seeing reduced point-of-sale activity, meaning fewer people buying their stuff in stores. Blamed it partly on general consumer caution, inflation worries making people think twice before buying a new fan or tools.
Got it. So, okay, we have strong underlying metrics in some areas like adjusted EPS and HBP, solid cash flow, buybacks. But the market reaction was, well, not great.
Not great at all. Classic Wall Street, maybe. Sometimes the headline negatives just overshadow everything else initially.
How bad was the drop?
The stock gapped down 10% right at the market open on August 6th, the day after the report. And it closed the day down almost 14%.
On heavy volume.
Very heavy volume. So lots of selling pressure. The market skepticism seemed laser focused on that top line revenue miss and that big Hunter Fan impairment charge.
Even though it was non-cash.
Even though it was non-cash. It seems investors just prioritized the negatives, the demand issues, the tariff uncertainty in CPP, and decided to de-risk, sell first, ask questions later perhaps. The strength in HBP and the inline adjusted EPS didn't seem to matter as much on day one.
Okay, so the market is clearly worried about CPP right now. What could potentially change that negative narrative? What catalysts should investors be watching for?
Good question. There are a few things. First, obviously, any sign of tariffs normalizing or customer ordering patterns stabilizing in CPP would be huge. If that uncertainty clears up, it could really help.
Makes sense. What else?
Second, continued positive data on the housing repair and remodel market would provide ongoing support for the strong HBP segment. Keep an eye on those broader trends.
Okay.
Third, just the company continuing its capital return program, more buybacks, steady dividends that provides a level of underlying support for the stock value.
Consistency matters.
It does. Yeah. And finally, the big one is probably the next earnings report, the Q4 and full year results. That'll be the next major guidance checkpoint.
What will we need to see then?
If they can show a credible rebound starting in CPP volumes, or give clearer guidance on tariffs, or even just strongly reiterate confidence backed by continued HBP strength, that could lead to a re-rating of the stock.
So Q4 is definitely key. All right, we've dug into the numbers, the strategy, the market reaction. Now, let's switch gears slightly. Time for the segment where we let our imaginations run a little wild.
But grounded in logic, of course.
Of course. This is not financial advice. Just a couple of quick speculative trade ideas based on today's discussion. Remember, purely hypothetical.
Highly speculative, significant risk involved. We're just kicking ideas around for educational fun. Don't try this at home without doing way more homework.
Exactly. Okay, my idea number one. I'm calling it the sum of the parts revaluation play.
Intriguing. Go on.
The thinking is the market hammered Griffon because of the CPP mess and that Hunter Fan impairment. But we know HBP is frankly, an absolute beast right now. Great margins, strong tailwinds.
Right. The market seems focused on the drag from CPP.
Exactly. I think the current stock price might be disproportionately discounting HBP's value. So the outrageous part, I'd think about going long Griffon stock, GFF, but maybe hedging it slightly by shorting a broad industrial ETF like XLI.
Okay, a pair trade.
Yeah. The bet is that eventually the market will properly recognize HBP's strengths, causing GFF to outperform the broader industrial sector, even with CPP's issues. It's betting on that segment value eventually shining through.
Interesting. A bet on value realization, overcoming negative sentiment. Okay, my turn for an outrageous but plausible idea.
Thanks, Aaron.
Mine focuses on that uncertainty around CPP and the impairment charge. Management called Hunter Fan's situation optical versus operational and believes it's at a low point, but the timing of any recovery or tariff clarity is totally up in the air.
Which the market hates. Uncertainty.
Precisely. So there seems to be a lot of uncertainty priced in. Therefore, I might consider a long straddle options play on GFF going into the Q4 earnings report.
A straddle. Buying both a call and a put option.
Exactly. Buying an out-of-the-money call and an out-of-the-money put, both expiring shortly after the next earnings release. The outrageous part is you're betting on a big move, but you don't care which direction.
A pure volatility play.
Right. If CPP surprises positively with tariff clarity or demand bounces back, the stock could rip higher, making the call option valuable. If things get worse than expected, it could fall further, making the put option valuable. You're betting the current uncertainty means any definitive news will cause a sharp move.
So you profit if the stock makes a big jump up or down. Interesting. Definitely plays on that contested nature of the stock right now.
It's betting on resolution, one way or the other.
Okay, two very different, definitely speculative ideas there. Let's bring it back and wrap up our deep dive on Griffon's Q3.
Sounds good. So the key takeaway really is that mixed bag. You had the big GAAP loss because of the impairment.
But adjusted EPS was actually in line, and adjusted EBITDA grew nicely year over year.
Right, and that divergence was driven by the two segments. HBP continues to fire on all cylinders, benefiting from those strong remodeling trends.
While CPP is really battling weak consumer demand and those tariff disruptions, leading to lower revenue and that Hunter Fan write-down.
Management's response, cutting the full-year revenue forecast, but crucially, holding firm on their EBITDA guidance. They're banking on cost controls, the asset-light model, and HBP's strength to pull them through.
And the market's reaction so far has been negative, focusing on the CPP issues and the revenue miss.
Yeah, but potential catalysts are out there. Any stabilization in CPP, continued strength in HBP, ongoing buybacks, and especially that Q4 earnings report could change the story.
Absolutely. So we've distilled the key insights from Griffon's call for you. Remember, this is all for educational purposes.
Definitely not financial advice. Always do your own research and maybe talk to a professional before making any investment decisions.
We hope this deep dive is giving you a much clearer picture of what's going on with Griffon.
Yeah, thinking about that HBP strength versus the CPP weakness, what part of that story stands out most to you right now, based on what you're seeing elsewhere in the economy? It's an interesting dynamic.
Definitely food for thought. Join us next time for another deep dive where we'll bring you the crucial insights you need to stay informed.